Hello everyone, thanks for checking out my video. The US stock market plunged last Friday to end the week as the market sell-off intensified. Just that Friday morning itself, $2.9 trillion were wiped out from the US stock market due to fears of a global recession. That was the worst day since 2020 COVID crash. In fact, over the past few weeks, the S&P 500 has erased $3 trillion in market cap since July 16. We also saw Nvidia swinging $500 billion of market cap every other day like a meme stock. Not just that, even Russell 2000 that tracks the small cap stocks was down 7% last week. And lastly, the tech-heavy Nasdaq 100 has officially closed in the correction territory as it has gone down over 10% from its all-time high. So, will this widespread massive sell-off continue for the rest of August? Is recession really coming? Let's discuss them in this video. Also in this video, I have lots of things to share for my options trades with some key takeaways. Therefore, as usual, do stay throughout to find out more. Alright, US stocks declined sharply last Friday as a surprisingly weak employment data reignite worries and fears that the economy could be falling into a recession. Basically, US added 114,000 jobs in July, which is the lowest since January 2021. The expectation was 176,000. So can you see the big difference? That was why the market was caught off guard. On top of that, the unemployment rate rose to 4.3%, which is higher than the expectation of 4.1%, and this is the highest percentage since October 2021. And in case you're not aware, before Friday's jobs report, we already had some unfavorable economic data where we saw the initial jobless claims came in higher than expected at 249,000 versus the estimate of 236,000. Notably, this number is a 11-month high. And then we had the ISM manufacturing coming in at 46.8, lower than the expected 48.4. This means that the manufacturing sector or the economy is contracting instead of expanding. As a result of the series of weak economic data, we saw a wide spread of sell-off last week. All three major indexes recorded a weekly loss. The S&P 500 and Dow Jones fell 2%, while the Nasdaq dropped 3%. Interestingly, the Russell 2000 small cap index fared even worse, posting a weekly loss of about 7%, so much so for a market rotation. Moving on to a new week, investors will be looking to see whether there will be a rebound from last week's ruthless sell-off, especially for the tech sector, as tech-heavy Nasdaq 100 has fallen more than 10% from its recent all-time high in early July. The tech giants have posted mixed results in the last 2 weeks. So let's see if they can stabilize and find some footing. Meanwhile, a fresh lineup of major companies and retail favorites will be reporting their earnings this week, such as Palantir, Disney, Uber, Shopify, and Reddit. To add on, I believe the chatters on the first rate cut will continue into this week as many believe that something in the economy is about to crack and that the Fed has been slow in cutting rates. Based on the latest stats from Fed Watch 2, the market is now pricing in a 69% chance that the Fed will cut interest rates by 50 basis points in September, which means the market isn't even talking about 25 basis points anymore. A 25 basis point cut seems like a minimum now. Okay, let's move on to the technical analysis segment. Well, among the various stocks that I am gonna cover, Apple's chart looks like the better one, relatively speaking. First of all, as you can see, it has gone above the short-term blue downtrend line. Secondly, Apple has held the 61.8 Fibonacci level. This is a level that I have said is a critical one. You will be able to understand better as I cover the other stocks later. Anyway, come this week, we really don't know if the market sell-off will continue, and if it does, whether Apple will join the selling spree. Whichever the case, watch that 61.8 Fibonacci level at 218. If it breaks, it means Apple is entering this mini consolidation zone between 206 and 218, which also means it opens the door for Apple to fall towards the bottom of the consolidation area, below 210 basically. Along the way, it may find some support at the 50 moving average at around 212. But here's the thing to note, the longer Apple stays below the 50 moving average, the more bearish it is. Last of all, Apple bulls will not want the 206 level to be breached, because when that happens, I really don't see much support below, which means Apple could fall below 200. On the other hand, if 218 continues to hold this week, that's slightly positive, but not to the extent of calling it bullish yet. As you can see, Apple has been dangerously floating around this level for the last 8 trading days. So Apple needs to stay above and stay clear of this level for us to call it bullish. We are talking about at least reclaiming the 38.2 Fibonacci level at around 226. Above 226, it will then stand a high probability to fill that tiny gap between 231 to 232. Okay, in the event that Apple cannot reclaim 226 but continues to stay above 218, this means Apple is consolidating before a big movement. We have seen that on 2 occasions recently. Coincidentally, on both occasions, the next big movement is towards the upside. But this doesn't mean it will be the same this time, so watch those levels that I shared closely. Moving over to Tesla. Tesla was so volatile last week. From Monday to Friday, its single day movement was like at least 4%. It's crazy. This was why I traded Tesla 3 times last week. More on that later in the options trading segment. Anyway, I love how Tesla is moving so nicely below that short-term blue downtrend line that I talked about in my last video. To add on, I also mentioned about that long-term purple downtrend line. Okay, come this week, watch these 2 trend lines again. I mean, as you can see, Tesla attempted to break above both trend lines last week, but got rejected by both of them. So for Tesla to regain its bullish momentum, it needs to minimally get above these 2 trend lines. Otherwise, my short-term view of Tesla remains bearish. The specific level to watch on the upside will be 231. Above this level, it gives Tesla a high probability to fill the big gap between 234 to 245. If Tesla doesn't get rejected at the top end of this gap, then yes, we would say that Tesla has reversed its short-term trend and that we will likely see 250s and 260s range. On the other hand, okay, just a quick one, if you have found my free content useful, do consider supporting the channel through any of the following methods, such as buying me a YouTube super thanks or a cup of coffee via my Ko-Fi link. Alternatively, you don't have to pay a single cent. You can just simply tap on the like and subscribe buttons, and perhaps comment something below. Alright, going back to Tesla's chart, in terms of the downside, there is one major level to watch, and that is none other than the 61.8 Fibonacci level at around 207. In fact, I will give and take a little since Tesla is so volatile. I would say watch out for the area between 204 to 207. Why so? Very simple, we have 3 big support levels coming together, and they are the 61.8 Fibonacci level as mentioned earlier, as well as the 50 and 200 moving averages. This area has to hold. I repeat, this area has to hold. Because if this area gets breached, I would say there is a high probability of a waterfall, where we could see Tesla falling below the psychological level of 200 and head towards 180's range. Well, let's say Tesla were to drop $20 from the current price to around 188, that's a close to 10% drop. Not saying it will happen, but there is a chance for it to happen if the 204 to 207 area gets breached. To summarize, Tesla is now standing at the edge of a cliff. Let's see if it can make a U-turn or it gets pushed down the cliff. Be very careful if you are trading Tesla this week. Let's now hop over to Google. In my last video, I mentioned that the candlestick on 26 July has fallen completely out of the Bollinger Band. That means early last week, Google may just chop around 160's range and unlikely to go below 160. Well, it actually happened as per what I have shared. In fact, it continued to go sideways for the entire week. For this week, it's quite straightforward. We only have 2 levels to watch. One of them is the 61.8 Fibonacci level at 174, while the other is 162. Let's talk about 174 first. Okay, remember all this while I have been saying how critical the 61.8 Fibonacci level is? This is one example. The moment this level gets breached, the movement usually stays bearish, unless of course it can reclaim that level ASAP. At the moment, it appears that Google is lacking strength to go above it. It did test the level and attempted to go above on 2 occasions, but got rejected. Therefore, for Google to be bullish, it has to reclaim this level with at least 2 green candles, as simple as that. Otherwise, it's still bearish. If it somehow can reclaim 174, then I think it may continue to march towards the gap between 176 to 181. On the bearish side, 162 is a level to watch. If this breaks, then Google stands a high chance to fill that big gap up between 156 to 162. Well, if Google starts falling back to 150's range, I think this could be my first buying range. Anyway, if Google somehow couldn't get above 174 and also doesn't go below 162, that means it is consolidating at the 160s range before the next big movement. Next up, let's check out Meta's chart, and Meta is another example of how important the 61.8 Fibonacci level is. As you can see, since Meta broke below that Fibonacci level on 17 July with a big fat candle and higher than average volume, it remained bearish and stayed below that level until its earnings date. If it's not for its decent earnings, I don't think Meta could have reclaimed that 61.8 Fibonacci level so easily. But despite going above this level, which is around 488, Meta is not out of the woods yet. Let me break it down for you. First and foremost, that candlestick on 1st August, which is post-earnings day, shows that Meta gapped up and opened at a high price. But later on, bears stepped in to push the price down. This is why the candlestick is red, despite Meta popping 4.8% that day. And then on Friday, 2nd August, that candlestick is the textbook version of a long-legged doji candlestick. It is a signal that there is an indecision in the price movement. But in my view, since Meta's earnings were decent and it surged more than 4% post-earnings, it should be bullish, right? But somehow, bears stepped in last Thursday, and by the time when the market closed on Friday, the bulls were losing a bit of footing and thus creating the indecision candlestick. This, to me, could be a sign that bullish earnings sentiment is changing. But of course, I could be wrong and I stand corrected. Let's see what can we look out for to confirm the reversal of the post-earnings bullish sentiment. Once again, watch that 61.8 Fibonacci level at 488. Meta is sitting right at this level. Just like Tesla, it's standing at the edge of the cliff. If it falls below 488, then it's falling off the cliff, which means we can say hello to 470s and 460s range again, where the next consolidation zone is. In terms of bullish thesis, if you could recall, last week I talked about this bullish inverse head and shoulder pattern. I also mentioned that above 488, it has a high probability to charge towards 500 at least. And Meta did exactly that as it flew past 500 and hit 520's range. Here is what's interesting, because in my last video I also shared that Meta has to get above 521, which is the neckline of the inverse head and shoulder pattern. If that happens, we can say hello to new all-time high. But unfortunately, Meta only went above this level during intraday and ended that day below 521. That's called a rejection of the neckline. So to summarize, if we want to see a bullish Meta, it needs to reclaim the 61.8 Fibonacci level again, as well as to break above the neckline at 521. Let's now jump over to Microsoft. Here's another example of how important the 61.8 Fibonacci level is. Again, as you can see, the moment Microsoft fell below that Fibonacci level at around 429, it has remained bearish. What makes it worse is that it did try to get back above it, but sadly it got rejected. Come this week, in terms of the upside, it's straightforward. Basically, get above this 61.8 Fibonacci level with solid green candles and volume. If you can do that, I would expect Microsoft to continue to charge towards 438 at least to test the 50 moving average. It might even go up to fill the tiny gap between 441 and 443. On the other hand, if Microsoft fails to go above 429, pay very special attention to 399 to 404 area. This is where the 100% Fibonacci retracement level sits, as well as where the 200 moving average and that little gap are. If this area breaks, I think there is a high probability for Microsoft to hit 390 at least. Okay, at 390 it has to hold because I don't see much support below until sub 380s, where the mini consolidation area is. Last but not least, let's check out one of the most volatile stocks in the past 1 week. It's amazing how Nvidia can gain and erase hundreds of billions of market cap every other day. Its volatility is very comparable to Tesla, or perhaps even more volatile than Tesla. Anyway, just like many of the other stocks that I covered earlier, watch that 61.8 Fibonacci level closely this week. That level is around 100, which is a big psychological level by itself. To make things even more interesting, there is also a gap below it, between 96 to 101. Alright, so if Nvidia falls to this 96 to 101 range, be on a very high alert. Reason is because below 96, there is this consolidation zone that ranges from 75 to about 95. Therefore, if Nvidia doesn't bounce from that gap area, there is then a high probability that we could see Nvidia hitting 80s range at least. At the 80s range, watch the level 80 closely because this is where the 200 moving average is. The last time when Nvidia was trading below this moving average was January 2023, right before we saw a bullish golden cross on the chart, where the 50 moving average crosses above the 200 moving average. Therefore, if Nvidia falls below 200 moving average, then it's very bearish. We may just continue to head lower towards the other gap between 68 and 74. Okay, but let's take one step at a time. Let's watch how Nvidia reacts to the top gap first. On the other hand, if Nvidia can hold a 61.8 Fibonacci level, or if it bounces off the gap area, that's a positive sign. But again, for me to be convinced that Nvidia has reversed its bearish trend, it needs more than 2 green candles above the 61.8 Fibonacci level, given how volatile this stock can be. Okay, for me personally, I would want to see Nvidia reclaim that 50 moving average at around 120. Then we could potentially say that Nvidia is on the verge of reversing. Yes, you heard it correctly. Even if we get above 50 moving average, I am still not entirely convinced yet. I will only be convinced by the bullish momentum if Nvidia can go above 125. That's when I see a chance for it to hit 140 again. Alright, moving over to the options trading section. The first 3 trades that I am gonna cover are quick scalp trades, where I earn quick profits in the space of about 5 to 15 minutes. Okay, the first trade is this covered call on Tesla that was traded on 30th July, last Tuesday. So what happened on that day was that at around 11:30 PM Singapore time, I saw Tesla broke the intraday low. That was bearish, but I still held my bullets because I wasn't sure if it was a fake out. And then, in the next few minutes, I saw a few red candles printed on the chart, which has proven that Tesla was indeed bearish. On top of that, when I look at the daily chart, at that point there was a gap between 222 and 224 waiting to be filled, which I posted on Momo. Given the 1 minute chart was so bearish, I was of the view that there was a high probability that Tesla will fill this gap. Therefore, shortly after, at around 11:38 PM, I sold a bearish covered call and received a premium of $1,500. And the moment my sell order got filled, within 30 seconds, I quickly placed a buy order with an asking price of $14.45 or $1,445. The reason for doing so is simply because I told myself not to be greedy, just earn $50 for next day's lunch and dinner will do. Guess what? After I placed that buy order, which was also at around 11:38 PM, I went to brush my teeth. And then when I came back at around 11:45 PM, I saw that my order was already filled 2 minutes ago at 11:43 PM. This means that the entire trade was a done deal in the space of 5 minutes. Well, $50 profits in 5 minutes, that's $10 per minute. Not too shabby, right? Okay, moving on to the second scalp trade that took place on Thursday, 1st of August. It's once again a covered call on Tesla, because once again Tesla was looking weak when the market opened. In fact, the entire market was looking weak that day, except for Meta, who surged after its earnings. So I decided to watch the 1 minute chart for Tesla again. That's when I saw a beautiful setup. It is a classic bearish head and shoulder pattern. So at around 10:20 PM, I saw that Tesla was testing the neckline, and given the overall bearish market movement, I was of the view that there was a decent chance for Tesla to break that neckline. Therefore, I quickly sold a covered call and received a premium of $1,550. So shortly after, Tesla really broke the neckline, and that was when I knew the bearish trend could continue. This was why I wasn't too eager to take profits at $50. I held on to the contract for a little while more, and at around 10:32 PM, I saw Tesla broke below the intraday low. In case you don't know, a break below intraday low usually means more bearish movement could come. But that being said, at that point my profit was already at around $100 and I thought it was enough. Therefore, I decided to buy back the contract at $14.45. With this, the profit that I made was around $105, or in the space of 13 minutes, which works out to be about $8 per minute, which again isn't too bad. Okay, moving on to the third quick scalp trade on Tesla. So last Friday, 2nd August, when the jobs report came out, it was obvious that the market didn't like it, and there was a massive sell-off since pre-market. In short, the overall market trend was bearish. And please remember this sentence: trend is your friend until it bends. Just to add to that, there have been people who ask me what's my prediction of a stock direction after its earnings report or CPI or other key events. Well, if you have followed me long enough, you would know that I always let the market makers go first, then I follow after. Let them decide the trend, and then we follow the trend. There is no need for prediction. The earlier trade and this trade are perfect examples. I mean, why guess what will happen after Powell's speech? Why guess what is the market after jobs report, after earnings report? As you can see, after the jobs report, the market makers decided to bring the market down, and so I followed, and here's how I did it. Basically, last Friday, Tesla opened lower than the previous day's close, which was bearish. It then started to chop sideways a little bit before falling further, and then it rebounded. And that is when I knew my opportunity is coming, because in such a strong downtrend day where almost the entire market is selling off and market makers want to dump their shares, any bounce is likely a dead cat bounce, which means many people will be shorting the pop. And so I waited and waited. Then at around 10:36 PM Singapore time, I saw Tesla broke below the support line. Not just that, MACD was also on the verge of having a bearish cross. That's when I knew the bearish momentum is going to continue. Therefore, I quickly sold a bearish covered call and received a premium of $1,675. True enough, Tesla continued to fall in the next couple of minutes, and at 10:42 PM, just 5 minutes later, once again I told myself, don't be greedy, take the profits and run. So I bought back the same contract at $1,600, thus making a $75 profit in return. Well, $75 in 5 minutes, that's like $15 per minute, which is better than the earlier two trades. All in all, I earned about $230 for 3 quick scalp trades, which is about 300 Singapore dollars, in just 23 minutes in total. I will take it anytime. Anyway, for the second and third trades, we could say that the overall market trend for the 2 days was so bearish, and since I was confident that when the intraday low got breached or when the support level broke, a bearish momentum could continue. So why not hold on to the contracts for a little longer? Because if I had waited longer, Tesla indeed went lower, and my profits could have doubled or even tripled. Alright, to address that, here are some takeaways to share with the viewers, which I hope you can take something out of it. First of all this could have, would have, and should have are hindsight views. Hindsight is always 20 out of 20. Secondly, don't be too greedy and don't be emotional when it comes to trading, especially so for day trading. Thirdly, learn to take profits, because profits are profits, no matter how big or small they are. They all add up, and nobody goes poor taking profits. But people do go poor or suffer big losses for not taking profits. Here's another perspective to look at the 3 takeaways. If you don't follow takeaway number 3 and you don't have a profit taking plan or don't stick to it, that's when you could see your profits evaporate in minutes. For not following your profit taking plan, that could be a sign of being greedy. And when your profits disappear, you may get emotional, which is point number 2, greedy and emotional. And when you start losing not only your profits but also your capital, then all the should have, would have and could have will come out. And that's point number 1. As you can see, they are all intertwined. At the end of the day, trading is no easy feat, especially day trading. I am not an expert, just a beginner, but I do think these are some decent takeaways for viewers' consideration. Okay, this section is getting very long, so I am gonna summarize and compress the remaining 2 option trades. The first one is this cash secure put on Tesla that expired last Friday, 2nd August. This contract was sold on 24th June with a strike price of 150. At that point, Tesla was trading in the 180s range and had displayed a few bullish signals. Therefore, I stepped in to sell this put contract, which was a bullish move. For more information about this trade, please check out the video link at the top. Anyway, Tesla closed way above my strike price of 150 last Friday. As such, the contract expired worthless and I got to keep the full premium of $153 without having to close my position. The last option trade to update is this cash secure put on Nvidia, which also expired last Friday, 2nd August. The contract was also sold on the same day on 24th June with a strike price of $99. What happened was Nvidia experienced a massive sell-off from 20th June to 24th June, dropping more than 12% across 3 trading days. And interestingly, there wasn't any change to their fundamentals that led to the sell-off. Basically, it was a little uncalled for. Therefore, I was of the view that a bounce was imminent. For more information about this trade, you can check out the same video as the Tesla's trade. Anyway, Nvidia did rebound shortly after, but saw another wave of selling off in the last 2 weeks. But fortunately, I gave myself enough buffer and Nvidia closed above my $99 strike price on expiration date 2nd August. Which means I got to keep the full premium of $160 without having to close my position. Alright, the US stock market kicked off the month of August with a sell-off after a series of economic data seemed to be showing some signs of cracks in the US economy. This has left investors wondering whether the economy slowdown is a result of the Fed keeping interest rates at historic highs for too long. Interestingly, just about half a year ago, any bad news on the US economy has been regarded as good news because a slowing economy indicates inflation is coming down. But fast forward to today, bad news is really bad news because the economy is slowing down at a faster rate than the market has anticipated and people are losing jobs. The concerns of the Fed's higher for longer interest rate stance might end in recession has caused the VIX index to spike to its highest level since March 2023. In case you don't know, VIX is often referred to as a volatility and fear indicator. Just last week, VIX has exploded and spiked 40%, and the stock market has hit extreme fear during Friday's session for the first time since October 2023. It's amazing how quickly things can turn in just 1 week. So is it time to panic? Not for me, it's time to get excited actually. As the VIX level increases, it means more volatility and wild swings in the stock prices, which is good for options traders like me. I mean, I have shared how I can make quick profits by riding on the market trend and volatility in the earlier options trading section. Do watch it if you have skipped that portion. Anyway, that's for my short-term trades. As for my long-term portfolio, I have stepped in a little bit for Microsoft last week. It was a very small amount, basically to just dip my toes in to get the ball rolling. I have set some entry points for a few stocks. Therefore, should the market sell-off continues this week, I will step in if the stocks on my watch list reach my target price. Alright, who's buying the dip or preparing to buy the dip, or is the fear so bad that you don't even want to think about entering the market right now? I would love to hear from you in the comments section below. Meanwhile, I couldn't emphasize further that I am generally still quite bullish for the rest of the year as inflation is coming down and a rate cut is imminent. But of course, my sentiment could change if something major really cracks in the economy or some black swan events spring up. When that happens, be sure that I will be giving you guys an update in my weekly videos. Therefore, do stay subscribed so that you don't miss any updates from me. Everything's free here by the way. Do help me tap the like and subscribe buttons as they are free as well. Thank you.